Ladies and gentlemen, a very warm welcome to the Dutch Blockchain Week 2020. We are already at day 2 and we're really looking forward to today's program, featuring several amazing speakers and a very interesting panel at the end of this session. We are live 3 days from the ABN AMRO headquarters in Amsterdam. ABN AMRO is also our key partner for this event, and we are very thankful for them making this event happen. Next to our other sponsors, Computable and TechLeap. Many thanks for your support. This event is also brought to you by the Blockchain Netherlands Foundation, which is the organization and ecosystem for all blockchain startups and scale-ups in the Netherlands. My name is Scheele. I'm co-organizer and host for this event, and I have the great pleasure being joined by Rudolf van E, who is also co-organizer of this event. I also would love to express my deep thank you to the marketing communication volunteers, Vladimir, Marnix, and Marnix. Many thanks for all your support. We really appreciate it. So the first session of today will be about the future of finance. Blockchain is said to have the most impact on the financial sector. And in the past years, we've seen the meteoric rise of DeFi, CBDCs, Libra, and so forth. So we're very keen to learn what is next for finance in blockchain in the upcoming years. Our first speaker today is Rens van Tilburg. Rens is an economist with an extensive knowledge of sustainability, innovation, and finance. He is director of the Sustainable Finance Lab and previously worked at the European Parliament and the Dutch House of Representatives. His research interests include the question how to finance the transformation for the economy towards more socially and ecologically sustainable path. Without further ado, I would like to welcome Rens van Tilburg to the virtual Dutch Blockchain Week stage. Rens, welcome.
Yes, thank you very much, Jan. Thank you all for your attention. I was asked if I wanted to say something, give a short introduction on the topic of central bank digital currencies, more in particular the idea of a digital euro, which is a topic that we at the Sustainable Finance Lab have been pushing actually over the last 2 or 3 years. Maybe very shortly as an introduction of Sustainable Finance Lab. So we are an, I would say, academic think tank, started about 10 years ago after the last big financial crisis, the Lehman crisis, so to say. We have as our members mostly professors from different universities in the Netherlands. And I'm the director of our secretariat, where we have 7 researchers working at Utrecht University. And it's also, we're started from Utrecht University by the then chair of Sustainable Finance Lab, Herman Wijfels. So why did we, I will mainly introduce why we as Sustainable Finance Lab became interested in central bank digital currencies. Then increasingly you will see that reality has taken over, and even without Sustainable Finance Lab now this thinking is very much progressing. So maybe to start with the question, what actually is a central bank digital currency? So what we see here is the so-called money flower, comes from a report of the Bank for International Settlements, which on various dimensions helps you to see what kind of money, different kinds of money there are. And I cannot really point it out, but on the lower left you see the cash, which is given out by central banks, central bank issued. So that's the blue circle. And it's universally accessible. So that is sort of like the old money as we know it. Increasingly, however, money has become a deposited currency on the accounts of commercial banks. And the CBDC is really in the middle of this. So it is like cash. It is issued by a central bank. but it is digitalized. It's electronically, in that sense, it's a new kind of money. So there already exists central bank digital money, but that's only for the wholesale market. So that's and it's the reserves that banks have at the central bank. And the new thing that I will be talking about now is that you would have an access of all people in a country to the central bank, so they can all have an account with the central bank. Now, why did we become interested in this idea? It essentially started when we were writing a report with the Sustainable Finance Lab, looking at how the financial reforms had developed after the Lehman crisis. So in 2018, we made a report on 10 years after Lehman. Did we really learn our lessons? Now, and this graph plays a very central role in our analysis. So what we see here is, first of all, the economic cycles. That's the red line. And as you see, it goes up and down. It always has, and it probably always will. However, there is this strange blue line in this graph as well, which is the so-called financial cycle, which means is a combination of how the credit growth of banks is developing, as well as the house prices. And what we see here is that over the last couple of decades, this financial cycle is increasingly having larger directions up and down, and is for that reason more and more steering the real economy. And so what we see is that the moment that the financial cycle is about to turn, when it has reached its peak, it often brings down the real economy with it. And in that sense, I think this is a very good illustration of how the financial sector has become increasingly dominant over the real economy, which I'm an economist and I've always learned that the financial sector is supposed to be at a service to the real economy. And that is something that has been changing over the last decades. Now, this is a picture of the United States. Actually, if you would draw this picture for the Eurozone or for the European Union, it would be have less of an amplitude. But if you would write it for the Netherlands, then it would be very much look like this one, because in the Netherlands we have a very specific financial sector, and that's something that this picture also illustrates. And so, on the one hand, what we see here is how big the banks in a country are compared to the GDP, compared to the economy of a country. So what we see is that actually over a very long time, it has been quite stable. So the blue line is the average for the OECD countries. And it has been like somewhere between the 50 and the 70% of GDP for over 100 years. And then in the 1970s, that's a very special moment in financial history. We may come back to that at the questions. But you see that this line is going upward. And the Netherlands is even almost like a world champion when it comes to having the biggest banking sector. And before 2008, this was to a certain extent a source of pride for the Netherlands. And we were seeing our big banks going all over the world. And we felt pride that they were showing the world how to do finance. But that very much changed in 2008 when we all of a sudden needed to support with public money those banks. It cost us a lot of money. It brought a lot of austerity and therefore economic problems. And actually, from then onwards, increasingly studies have shown that actually indeed for a developing country, a growing banking sector is a good thing, but there is a certain optimum, and you don't want to go beyond that optimum. And that optimum is much lower than where we and actually most Western countries are. Now, we're not only having a very big banking sector, but it's also highly concentrated. So here you see that in the Netherlands, the top 5 banks, and actually that's almost the top 3 banks, have about 80% of the market that they own. And those are numbers that you only find in very small countries where you have very little banks, actually. And you see that the larger countries, then often it's like somewhere around 40-50% that the top 5 banks have. also, the banks in the Netherlands are roughly doing the same thing. So here we see the evolution of the Dutch banking sector from the 1960 onwards. And we see in 1960 there was still quite a large diversity, all kinds of different banks having different governance, different ownerships, focusing on different sectors, doing different things. And increasingly, we see that they have become more and more uniform, and therefore the banking sector more and more has become a monoculture. And as we know, monocultures are quite vulnerable for certain shocks, because if there's one shock that would one bank, that probably means that it will bring down all the banks, given that they look so much like each other, as they do in the Netherlands. Now, what actually have banks been doing? And I think this is a very telling graph in that sense. So when I was studying economics in the early 90s, I was always learned, and actually this is what students still learn at university, that banks are primarily there to finance the real economy, to decide which entrepreneurs need money for developing their company. And indeed, in the early 90s, this was mostly what they were doing. So that's the blue line. You see that in the early 90s, almost half of all the new credit given by the Dutch banks was going to companies. And only about 25% was going to people for their mortgage. But in the 90s, this has dramatically changed. And what we see now is that actually the main activity of banks is rather to finance mortgages, and much less so to finance entrepreneurs, the SMEs, the companies that actually with this money would make the economy grow. So my colleague from the Sustainable Finance Lab, Professor Dirk Bezemer, makes this distinction between productive credit and unproductive credit. And in that sense, if you lend to a company, the economy grows, and therefore also you can pay the interest out of that. However, if you finance mortgages, actually mostly what the money is used for is simply to raise the prices of the houses. So that's exactly what we have seen happening over the 90s. House prices have gone up very strongly, but actually the number of new houses being built went down during that period. And I must say, over the last couple of years, this has been more or less stable. But that means that still, for banks, their main activity is mortgage lending and not lending to governments. Now, in 2008, all these problems came together, especially also in the Netherlands. We had a lot of new research on the table. And therefore, the idea was we as a society, the Netherlands, but globally, have a problem with these very big banks that are too big to fail. So we need to find ways to, bring them more into line and stop taking excessive risks. Now, there were a lot of reports at that time, and there was a strong consensus at that time that we needed to have structural reform in the banking sector, that we needed to make a distinction between what is private and what is public, and to have public goods like, for instance, the payment system being taken out of the banks. So in the UK, the Vickers report was the first to propose this. But then in the Netherlands, we had also a report by Herman Wijfels, so at that time also the chair of the Sustainable Finance Lab, proposing this. It was followed up by a European Commission, the Liikanen Commission, who also said we really need to get rid of these this risk-taking around public goals. This also led to a proposal of the European Commission to make splits in between investment banking and retail banking, but that's where it ended. So by then, by the way, these ideas had already been watered down very much. And there was a very thick stack of papers that was the proposal. And I think rightly the banks by then said, like, well, this is way too complicated. We cannot enforce this. And in the end, the proposal was taken off the table. And in 2018, when we as Sustainable Finance Lab needed to draw our conclusion was that actually with this consensus from 2008 and 2009, nothing really had happened. Fortunately, this is not where the story ends, because other things did happen. For instance, the rise of digital payments through using the phone in Africa. So here we see a picture of M-Pesa. which is a way of payment developed in Kenya originally, but now it's used all over Africa and increasingly also in other places. You can use your mobile phone. It's developed by Vodafone and Safaricom to pay. So we see over these last 10 years on the regulatory front, maybe not much has happened, but we see that there's many different examples where alternative payment systems have been developed. Now, this comes also as a shock to central banks and to public policymakers, because there is a very long trend already, and we see it here, of how the real public money, which is this cash money, that's the money that's printed by the central bank, and where we see our sovereigns head on the coins. And it's in a strong decline. So in the beginning of this century, it was almost 80% of what we call money was in that form. But it has been steadily decreasing. Mainly, it has been replaced by bank deposits that we have started to use, and increasingly now also there's other forms of money, like for instance the Bitcoin. And we do see that in the recent years there's a stagnation or even maybe a little uptake of the use of cash. However, this is not in the payments being made. So if you look at the payments, then still the use of cash is very strongly going down. Still, the corona pandemic even accelerated that further. And so there is still cash in the system, but it's not as much used for payment purposes, but more as a store of value. Now, at SFL in 2018, we said that actually what we need is a new way, a digital way of public money. Because if you would privatize further, so we have on the one hand these banks who have their private interests intertwined with this public good of the payment system, and we have all these new private players that are coming to the market, which are unregulated and pose all kinds of other problems for monetary policy if they would really become systemic. So for that reason, we proposed that central banks should somehow find a way to play a role also in this more digital world. And that's the idea of central bank digital currency, so a digital cash, digital euro. But at first, the central bankers were actually quite reluctant to go in this direction. So this is an overview of a paper that we are still working on, where we have looked at a lot of different studies from central banks and official institutions like the BIS and the IMF, in which they sort of like look at where we looked. How do they value the different advantages that in general are being seen for central bank digital currencies? And how do they look at the disadvantages of that? And I don't have the time now to go into it, but I think this is about the disadvantages. And what you see is that there were strong arguments, they thought, in terms of stability, or the fear that if you would have digital cash, that if there would be doubts about the health of the private banks, that a lot of money would quickly move into the CBDC. And this would also lead to increased cost for banks. And actually, this was the reason why a lot of the central banks initially said, well, maybe we should not be going in this direction. And that was also probably because they felt that these private initiatives were not really that big, were not really reaching a critical mass, becoming a systemic threat for their role in monetary policy. Well, all that quickly changed last year in June, when Facebook announced the Libra plans. And I think from that moment onwards, there was really panic among central bankers who thought this would be really a problem for us. Because, of course, Facebook, it does not have the best name when it comes to attending regulation. And central banks, they felt rather comfortable for a long time with having the private banks playing a larger role in monetary policy, because they have a very strong and historic relationship with them. And there's a lot of regulation that central banks also as supervisors enforce on those banks. And it would be, my take, impossible to get such a relationship with new players like Facebook. At the same time, in China, things were also developing very quickly. So China, in that sense, is a front runner because they have had their own Libra already for a couple of years. They had WeChat and Alipay. And also there you see that the central bank is stepping in, and the largest experiments at the moment with central bank digital currency are actually taking place in China. So it's pretty hard to really grasp what is going on there. But we know that they're doing all kinds of experiments at the moment, very large scale, and the idea of the People's Bank of China is essentially the same as the ECB has with the digital euro, is that to not become too dependent on these new private players. Well, these developments really shifted the thinking. First of all, in the beginning of this year at the Dutch Central Bank, so they came with a proposal, a report, in which they were honoring a recommendation that we as Sustainable Finance Lab had been making, which is that in the Netherlands, given that we already are so much digitalized also in payments, that we would actually be a very good place to start in the Eurozone experimenting with the central bank digital currencies. And indeed, the Dutch Central Bank said we are willing to do that. But of course, we need to be asked, we need to be given the room to do that by the European Central Bank. And in October, so 3 months ago, the European Central Bank came with their report on digital cash. And it's a very interesting report, but the report is sort of like putting the options on the table. But we know from, for instance, how Christine Lagarde is talking about this, is that the European Central Bank is really thinking of going into this direction. So the first step actually would be then to start, like they are already doing in China, with specific experiments, giving access to digital euro to certain people, certain companies, and look at how different forms, different designs of this digital euro would work out. So that's actually what we are currently thinking about in the Sustainable Finance Lab, is what kind of experiments would you like to see? So what are the big questions we have about this digital euro? And here are some of the questions that we are currently considering. So I think, first of all, it's very important that if you want this digital euro to really be an alternative for the payment system of the banks, you need people to start using this digital euro. And when the ECB report came out, actually most economic opinion makers, their reaction was, who needs a digital euro? I mean, what's the problem with having your money just in a bank where there's a deposit guarantee system? So I think that will indeed that is a good question. So I think there is a public interest in creating this digital euro and having people use it. But for the individuals, it's not necessarily so clear that they really need to use it. So how are you going to make sure that they do? How to make sure that it's their primary payment account, that, for instance, their salary is coming in on that digital euro account. And the thinking is, so first of all, as you saw in the beginning, central banks were very much afraid of this CBDC because they thought it would make the banking system less stable. Now, in general, the idea is that for that reason, you should have sort of like a cap, so a maximum amount of digital euros that anyone can have. But there's also other possibilities in which you just say, well, on the first 3 or 5 or 10,000 euros, you still get a very good or a competitive interest rate. And if you put more on your account, then the interest rate will increasingly become less favorable. These are the kind of questions that central banks have, and that we need to find ways to experiment to see how this can work. Next to, of course, the large technological questions about this. So what systems to use, this is, I think, what we will see happening in the coming years, and I'm sure that will be of great interest to all of us. Thank you.
Rens, Many thanks, really many thanks for for your keynote. I have myself a master in finance from Maastricht, actually, so not from Tilburg, but hearing all these incredible insights, it's fascinating. It's very interesting, especially with all the latest developments when it comes to the CBDCs worldwide. I'm just interested about the plans in Europe. Yesterday, we heard some speakers about the regulation in the European Union and the first thoughts when it comes to the CBDC in Europe. Today, we will also have some great use cases from Africa. So also the M-Pesa from Kenya will definitely be talked about. So the DCEP, the Chinese CBDC, well, it's not an experiment anymore. Do you already know when it will be launched in the upcoming year? Is it already known, or do you have more information about that?
No, as I said, I think everybody is just guessing a bit about the timelines. I'm calling it an experiment because it's not official. It's not open for everyone yet. But indeed, what we hear is that it is really big experiments with many thousands of people and companies being involved. But they're not really part of the discussion, in a sense. Like you have a study group at the Bank for International Settlements, the Financial Stability Board, and I don't think China is showing a lot of what it's doing there. So it's mainly European and other countries. So it's also a lot of countries like Uruguay, Indonesia, Paraguay. I think they are also front runners in this sense, mainly for this idea of financial inclusion. So actually, Ecuador has been the first country to issue a central bank digital currency, but they actually already abolished it as well because the uptake was not high enough. And I think another country, I didn't mention it, but to really look at is Sweden, because so Sweden, like the Netherlands, has a very digitalized payment system already. But unlike the Netherlands, is not part of the euro system, so it can go ahead all by itself. I think they've been studying it for the last couple of years, and are about to go live with an experiment.
Yeah. So we have Ecuador, Paraguay, we have the Bahamas introducing the banana or the cents dollar, I think it was. Before we continue the discussion, for everybody at home who was not able to find the question button, it's actually on the right side. So on the right side of your screen is a drop-down menu where you can leave questions for Rens and, of course, all the other speakers. They're dripping in right now. We're just discussing the CBDCs all around the world. When we look at the CBDC, the DCEP in China, as you already mentioned, China is not really open, communicating about this project, although there have been all kinds of, airdrops and experiments in Shenzhen, etc., where you could see parts of the agenda actually that is currently being developed in China. Do you, in your lab, you probably also look at DCEP. Are there parts that you can see now in China where you're quite enthusiastic about and would definitely also advise the European government also to implement in their digital euro strategy?
No, I must say also because there is simply not so much that you can know about China at the moment. We are more focused on our own thinking, so to say, around the digital euro and what kind of form it should take. So when we started this discussion in 2018, for instance, one of the design choices was between do we want to have an account-based digital euro, or should it be more token-based? There were a lot of people saying, well, actually, if you would have it token-based, that would be much more similar to cash as we know it. So it's more anonymous, so it's better for privacy. There's all kinds of reasons why that would be like an easier option. But we were, of course, coming from this financial stability point of view. What we wanted was really a backup system also for payments. And if you would have a token system, that would not really be. You can only pay with the tokens if you are also physically near to each other. And therefore you would not really have this backup of the payment system. So we were arguing in favor of these such accounts. And now a big discussion is about whether or not to put a cap on the account that you have. So nowadays nobody's talking really about everybody's talking about the account system. The token system is a bit out of the window. It's more like a combination. So you have an account, but you can also use it as a token. And there is discussion about privacy issues. So how can you still keep privacy high and at the same time as a central bank obey all the know your customer, anti-money laundering, counter terrorism financing regulations. So my personal take is that I think in terms of privacy, this central bank digital currency will mean that there is much less privacy than we currently have with the cash money. Yeah. But that will decrease anyway. Also, in disregard of central bank digital currency. And so, as you see that the larger bills of the euros that have been abolished over recent years, it is also because with all this anti-money laundering activity. Increasingly, the spotlights are on the cash money because now that banks are increasingly able to work on that. There is a shift to cash, and for that reasons, I think the cash increasingly will be tackled by regulators as well.
Yeah. So in January, the European Commission, according to Christine Lagarde, will take a decision about the digital euro. So I'm very curious what will come out of this discussion. In January, according to the Financial Times, also the Libra project that was now renamed to DEEM will launch apparently. I don't know if you're already familiar with this. What can we expect? I mean, the Libra, it was supposed to, first deal with the regulators, especially in the US and, of course, also in Europe. But now it is set to be launched in January already.
Yes, and I think only launched with a dollar version. And so that's the difference from the original Libra was really like a bombshell because nobody saw it coming. And they were so they are a stable coin, so they take existing currencies and build on top of that their own payments. And they were saying like, well, we will take in dollars, yuans, euros, and we will decide ourselves in what combination and how we will change that. And that really freaked monetary policymakers out because that would mean that if this would really become big, and of course if Facebook is involved, this can become big. Then it would be up to Facebook to take such decisions, and that could have then huge ramifications for monetary policy in Europe, in the US. So that was sort of like they could not allow that to happen. And then I think half a year ago, Libra already changed their proposal. So they said we're not going to make one global Libra, but rather we have different regional versions. And so in Europe we will have one which takes the euro, and in the US we will have one based on the dollar. But they would take the the money. They would take deposits of private banks to underlie the value of the Libra. Yep. And I think in that sense, what you see now happening, and it's actually what you already see happening in China, or what's the idea, I think, of the People's Bank of China, is that they say, okay, you can have your Alipay, but then we want Alipay to be built on our central bank digital currency. And I think in that sense, Libra, or DEEM as it is now called, in Europe will probably in the future be using this central bank digital currency. instead of using the private bank's currency.
Will it also impact the digital euro? How will it impact the digital euro plans? I mean, well, the digital euro will be decided on in January if it will proceed in what way. But Facebook will already launch its products in January. How do you think it will impact the digital euro project?
Yeah, so I think if Facebook really starts in January, but again, I think they only start with the dollar. So we need to see when they come to Europe and use euros. So initially, they will, given that there is not a digital euro, they will need to use the deposits of the commercial banks and use those as the euros. But I think the moment that the digital euro is there, it will be more attractive for them to use that, because then they have no problems with the insecurity of the claim on banks and being above the deposit guarantee system. So in that sense, I think a digital euro can actually help Facebook create its Libra or its Diem. But also competitors of Facebook. So that's also very explicitly a goal that the ECB has stated around the digital euro, is that it should really stimulate innovation. So they want to be sort of like the back office, and it's up to all kinds of private initiative to decide how people can actually get into their central bank account.
Yeah. So speaking about the digital euro, another little competitor, Bitcoin. How do you see Bitcoin? Can it play a kind of store of value in your perspective next to the digital euro?
Yes, well, I've made myself very unpopular with some of my friends who asked me a couple of years ago. They said, "Rens, you know a lot about money. Tell us, should we be buying Bitcoins?" And I explained them that Bitcoin, in the end, it does not have any real value. So it depends just on how many people are using it. So I said, if for some reason people stop using it, and probably with developments like the digital euro, people might stop using this. Then it could go, the value could go to zero and you lose all your money. So, well, they're my friends. They listened to me. They did not buy the Bitcoin. And of course, they're very disappointed with me at the moment. But I don't know. I think in the long term, I still may be right. So if we do get the digital euro, and we get digital dollar and digital yuan, and they are connected to each other, which very much is what the ECB is hoping for, then it may still be that the Bitcoin becomes superfluous. But I already see people who are nodding their head. They don't agree. So there will always be people enthusiastic for the Bitcoin, and therefore keep some of the value in there.
Yeah. Well, you didn't tell your friends to buy a Bitcoin at the right moment. I told a friend actually to buy some of this, shitcoin as they usually sell it, at the top of the market. And he spent his entire wedding budget buying it to actually make his wedding even nicer. And after that, he had to postpone his wedding. So I know even worse stories
There's
about it.
Even worse advice possible than the one that I gave. Thank you very much.
Exactly. Rens, thank you so much again for sharing your very interesting insights with us. I thought it was very interesting to learn from your side, your perspective about CBDCs and so forth. If people would like to learn more, read more from your lab and from you personally, where can we find more content on the web?
Yes. Just on our website, sustainablefinancelab.nl. And if there's not enough there, you can always email me and we can get into touch.
Wonderful. Rens van Tilburg, many thanks and have a great day. And hopefully see you in Amsterdam soon in real life.
Okay, thank you very much.
Wonderful. Rens, thanks.
Bye-bye.
All right. Before we continue, as mentioned, if you have questions for our next speakers, so our next speaker and also the panel afterwards, you can use the drop down menu, which is situated on the right side of your screen. You can leave a question there. You can also tweet it with hashtag DBW2020 from Dutch Blockchain Week 2020, or you can go to our website, dutchblockchainweek.com/Q. And all your questions will end up in the studio, and we try to make sure that we can ask all the questions to our speakers. All right, let's quickly move on to our next speaker. DeFi is the talk of cryptocurrency in these days. Radix is one of the leading companies rocking the space. And with us today is its CEO and founder, Piers Radiaert. Piers, welcome to the virtual Dutch Blockchain Week stage.
Thank you very much. Great to be here.
Please take it from here.
Alrighty, so I have put together a little slide deck about DeFi, a brief introduction. If some people, I'm sure we've got some people amongst you who are absolute DeFi pros, and then some people who are like, I don't really know what this stuff is. So let's start with just what is decentralized finance, or DeFi for short. My working definition of DeFi is custodianless financial products, lending, borrowing, securities, and derivatives, built by many different teams on a public decentralized ledger that users are able to move their assets seamlessly between. And what this basically means is custodianless financial products means that when I put the assets into a financial product, like let's say I am lending my assets out, or I am doing some kind of swapping arrangement, the asset itself is being held by a smart contract rather than by a company. Built by many different teams on a public decentralized ledger means that there's this single fabric underpinning everything else, that many different teams are able to get involved, that they're able to build on the same fabric. And so what you get is this last bit, which is users are able to move their assets seamlessly between, which is one of the really key magic points of DeFi, because now, instead of having to go from a company to a company where each company I have to do this massive onboarding process, I can essentially take an asset from one financial product and move it instantaneously to another financial project built by a different company, built by a different team, built by different developers. And I can do it seamlessly because it all exists on the same underlying fabric, a public ledger like Ethereum or Radix. Now, a really simple example of this is the London Stock Exchange and the Shanghai Stock Exchange. This is the old school method of doing things. If you think about owning some stock on the London Stock Exchange, and you're like, hey, there's some stock on the Shanghai Stock Exchange that I really want, and I'm fully allocated. So what I need to do is I need to sell some of my stock on the London Stock Exchange to be able to buy something on the Shanghai Stock Exchange. Now, in the old world, the idea of being able to swap stock A listed on this London Stock Exchange for stocks B listed on the Shanghai Stock Exchange is sort of meaningless as an automatic operation, right? There's this concept in financial systems called atomicity. It's actually a database concept, but it means that you do two things at the same time, and they have to both succeed or both fail, right? And banks use this all the time. If I am sending money from my bank account to someone else's bank account, you want mine to be debited at the same time as the other is credited, and you don't want to end up in a situation where I have not been debited and they've been credited, because you end up creating money. But on top of the existing financial architecture that we have, there's these little islands of finance. And so London Stock Exchange is one of the islands. And I can't go stock A to stock B as a single instant transaction. I have to actually go into cash. So I'll go to the London Stock Exchange, I'll sell my stock, I'll go into cash, I'll then move the cash from the UK to China. And then once it's finally moved from China into China, I will then deposit it on the Shanghai Stock Exchange and buy the stock. Now, fundamentally, that's a very slow and relatively broken way of doing things. And it kind of works and big for the average consumer, but it sort of is broken in many fundamental ways. So what can DeFi do? In theory, it can kind of do anything that currently exists in financial services. And the main use cases that we're seeing are things like lending and borrowing. We're seeing derivatives. We're seeing automated market makers. We're seeing insurance. We're seeing assets. We're seeing automated investing. And this is because a public ledger is like Ethereum or like Radix, allows you to program anything that you want to be able to build on top of that ledger, including building financial products, being able to change an asset from one type to another, or being able to lend it from one place to another, or provide it as yield, or be able to repurpose it so that it goes from, say, for example, Ethereum to a stable coin if I'm using something like MakerDAO. And this is what I call the next layer of the money layer cake. So we started off in crypto with going, how would we describe decentralized value? And that's where things like Bitcoin and stuff like that came out. And the key around that was that it was able to be programmed. I could suddenly do if-then statements around it in a way that I didn't have, that users could use it instantaneously and frictionlessly. So there was no AML process, there's no KYC process, there's no registration process. Essentially, if you have a public-private key pair, you can interact with the system. And it's similar to what made the internet powerful, was this frictionless way in which you could suddenly interact with it. I just need an IP address to be able to interact with the internet. And so the first thing we did was this decentralized money. Now, once decentralized money had been created and the value had built to the point where that value made sense to start repurposing it for other products and services, then that programmability became even more powerful, because you could start to make if statements, and you can start to make full programs around what would happen with that value. And that's where we're starting to see some of the early products that are coming out of this. And there's a lot of benefits that happen here. Like, ultimately, users should see better returns on their money, because they have a wider amount of choice. In theory, have a wider amount of choice. If I build a product on top of a public ledger that is a DeFi product, its audience is global, and it's global instantly, because all of those people who already hold value on top of these public ledgers can move their assets, if they choose to, into these decentralized finance protocols, into these decentralized finance products instantaneously. And this gives them a better choice. Now, this does also mean that there are problems around this, and I'll go into sort of the things like the scams and the bugs and all that kind of stuff. But as a result, you also have less friction between moving assets. If you think about, if anyone has ever had a pension fund, a company pension scheme, and tried moving between company pension schemes, or consolidating your assets, or moving bank accounts in certain countries, or indeed, as I was giving before, moving money between brokerages, or if you have a trading account in America and a trading account in Asia, and being able to consolidate those two and actually use those assets as a single basket, you'll understand how complicated money can get. But fundamentally, what DeFi is providing is this single underlying fabric that allows you to move assets frictionlessly between these places that are offering you different opportunities for that money. And that ultimately also gives users more choice, because you are getting to the point where you have multiple competing. The only thing that's really stopping money flowing into a decentralized finance application a lot of the time is its competition with others on the same fabric, which is great for the consumer, because it creates all of this competition to create better and better products that can very quickly be spun up and money can be deposited into. And this is fundamentally, these three things is what Radix really focuses on, and this is why we focus on the DeFi industry specifically. But this concept of access, liquidity, and choice is fundamentally what drives DeFi, and what we're getting this huge growth in the DeFi space out of. So there's also some really interesting, unique aspects about how DeFi works as well. One of the key innovations is this concept called the constant function market maker, which, if you ever want to sort of go down the path of understanding like how simplicity and elegance can actually end up being it can end up with interesting innovations. But Uniswap has $1.3 billion of liquidity locked in it. And unlike normal market maker functions, if I look at how a centralized exchange like the London Stock Exchange or like Coinbase or any of these places work, market making is a professional activity. What people do is they come onto the exchange and they make sure that the spread between the buy and sell of a stock that's trading is nice and tight. But to do that, you constantly have to be moving your buy and sell orders often on the book as the price moves up and down. And that's quite a complex, in-depth operation, which means that market making and liquidity provision is generally done by professional organizations. In DeFi, suddenly it's become crowdsourced, community-sourced liquidity, which is being provided by people who can just put their assets into these protocols like Uniswap. And the protocol automatically makes a market from those assets for the users. The users earn fees from doing so, but don't have to be professional market makers. It essentially takes 3 clicks to do this. And then you also have the same thing in automated lending protocols. Like $1.52 billion of assets are currently right now being lent out in Aave. And the people who have things like Ethereum or wrapped Bitcoin or any of the sort of ERC20 tokens that are out there are earning $1 million in fees a day for lending out their collateral. But all they had to do was have a MetaMask wallet and visit the Aave app interface, and they could deposit and start earning instantly. And that is really powerful. This programmatic 24-hour finance is really powerful, and it's powerful because because automation sits at the very heart of it. So all that sounds fantastic, right? Obviously, there are some challenges. The first challenge of this is gas, which is what Ethereum's word for transaction fees are essentially. So during the August and September, there was a huge DeFi boom, and Ethereum essentially just got stuck. And it's got stuck before. Like we've been in the situation in 2017, and like it really hasn't moved on from there. And it was costing like upwards of $100 just to interact with DeFi applications, which was a problem for the little guy. And the reason that I think that's so key to DeFi is because for me, crypto often talked about this concept called the unbanked. It's banking the unbanked, which I really dislike as a concept because it feels like a very like rich country, poor country divide thing, which I think isn't what crypto is about at all. I think that crypto is about equality of opportunity, and so this idea that you can get into DeFi even with like $5 or $10 or $20, and you can start playing around with products and services that just would be completely not available to you in your country, completely out of your access because you didn't have enough funds to be able to put it in. You need a minimum of $50,000 or $100,000 to put it in the equivalent in the centralized financial ecosystem. But the Ethereum gas costs are still making it very expensive to as someone who doesn't have huge amounts of money to actually interact with it, which for me is killing one of the core things, the things that excites me about DeFi. Now I call this about accessing the underinvested, and I think the underinvested can exist anywhere. They can exist in England and America as much as they do in Nigeria and Ethiopia and Vietnam. And I think that's what DeFi is. That's what this is ultimately about, is an opening up of opportunity to everyone. And the other challenges that we got here is smart contract hacks and bugs, like this concept of YOLO and wrecked. Like YOLO, people probably know it means you only live once, but in DeFi it means throwing a large amount of money into an unaudited decentralized finance application, because you make most profits, normally most returns, if you get in early when the price is low. But often it turns out that the project itself wasn't properly audited and there's some kind of bug, and you end up in situations like Yam.finance, which had $220 million flow into it and then flow out of it all within the space of 4 or 5 days. And the BZX hacks, where there was this dependency between smart contracts, which ended up meaning that like $25 million was stolen. And this is a fundamental problem again with Ethereum and Solidity, which is the Ethereum development environment, which is causing these developers to make these horrible choices of being like, I need to get to market quickly because I need to take the opportunity as quickly as possible, but as soon as I go to market, people don't respect like beta testing or anything. They just put large amounts of money in and things go wrong. So the way in which Ethereum has been built to code and program on top of the Ethereum ledger is also really problematic for DeFi as well. So how is DeFi doing? It's doing very well, up and to the right, as everyone likes to see. In April, so January, we're about 300 million. April, we'd sort of raised to 800 million. We had a little blip. June, we went to 1 billion. August, 4.2 billion. September, 10 billion. October, 11 billion. And now we're at $14 billion of assets. Crypto assets. These are still crypto natives, so like things like wrapped Bitcoin, things like Ethereum, things like ERC20s that are created on top of these ledgers, but assets nonetheless that have real exchangeable value are being locked in these protocols and making real money for people. But we are still seeing these underlying problems. Ethereum transactions are back to their all-time high. You can see these spikes here, and this is how much it's costing people to use Ethereum, which is kind of insane. And like, you know, the maximum gas fee yesterday, someone paid $190 just to do one thing on Ethereum. And in the last 2 weeks, someone paid $2,513 just to do one thing on Ethereum, which is a really expensive cost. So this is sort of holding back the DeFi industry. And this was a problem when CryptoKitties, I don't know if anyone remembers CryptoKitties. It was 2017, which in crypto years is eons, but it was this amazingly popular gaming application that users all wanted to come and breed these kitties and then get the kitties out. And fundamentally, it caused the same problem on Ethereum: huge gas prices, lots of congestion, people struggling to get through. But now we're in a whole different ballgame, because in 2017, the problem was user to smart contract interaction. And that's what people thought what public ledger was all about. But in 2020, what we're actually seeing, what product market fit is for decentralized finance, what product market fit is for public ledgers, is application to application interaction. It isn't the fact that I as a user can do one thing with one financial application. It's I as a user can do many things with many financial applications, often simultaneously and often layered on top of each other, where I can have one smart contract that's speaking to multiple other DeFi smart contracts to create more and more interesting, helpful, and better designed financial applications. So if you look at like what's happening as transaction volume on top of ledgers today, you can see how much of these operations are actually occurring between smart contracts as well as from a user to a smart contract. And that's really is the crux of this, because we've ended up in this weird situation where the thing that is driving DeFi growth is composability, this ability to stitch together all of these different financial applications and create wonderful sort of liquidity and opportunity for people. And the way that you can describe composability is basically this train and hotel example. I want to go on holiday. To go on holiday, I'm going to book a train and a hotel, my favorite hotel. But if I can't get a train ticket, I don't want to book the hotel. And if I can't get the hotel, I don't want to book the train ticket. This is a very simple idea of composability. That's what is right at the heart of DeFi applications working with each other. But the problem is that every single public ledger has come along and gone like, right, we're going to solve this with sharding. We're going to cut the blockchain up into lots of different subchains or subnets, and we're going to let applications be on lots of different shards to increase the throughput. But then it breaks composability. And this is true for Ethereum 2.0, which is going to break DeFi composability. It's true for Polkadot, it's true for Avalanche, it's true for Cosmos, which is what's so interesting about what is going to happen with the DeFi industry over the next 2-3 years, because fundamentally the solutions that people built, that they designed from the lessons in 2017, hey, we need user to application scalability, just aren't actually true about what makes DeFi special and what makes it powerful. So we're going to see some really interesting changes in the industry, I think, in the next 2 to 3 years. And obviously that's what Radix has been built specifically for. We built our layer 1 specifically to serve DeFi. And to do that, we really did 3 things. The first is make sure that we didn't break composability in how we scaled. Number 2, made sure that it scales linearly. And number 3, make sure that it works with multi-ledger assets, which means that basically we don't mind where the assets are coming from. We just need to make sure that as many assets as possible have access to this ecosystem to get you into this place where you have as much interoperability of assets, of users, of financial applications that's possible, that creates all of this wonderful innovation that has been driving this huge growth in total assets under management in DeFi to today. So if you want to find out more about Radix, please do go to our website, radixdlt.com. You can email us at hello@radixdlt.com. You can also get me on Twitter at Piers Ridyard, and you can get us on Twitter at radixdlt. And with that, I will hand you back over to
All right, Piers, many thanks. Your enthusiasm about the DeFi scene is mind-blowing. I've been sitting here being completely silent and listening to your story. It's very, very interesting to hear actually what DeFi is about, but especially what are the next steps in the scene also in the upcoming months. We've seen all kinds of concepts. We've seen gas, we've seen Polkadot, FOMO solutions, and so forth. But I'm just curious to learn. We have a majority of our listeners at home are Dutch citizens. Right now, if you don't have shares or big amounts of money, why would I enter the DeFi space, according to you?
I think there's some macro trends that are coming down the line that are really interesting. Like the COVID is going to have a massive impact, has already had a massive impact on the global economy. It still hasn't had that much of an impact on the share price for whatever reason. I think much of that is being sort of propped up by the huge amount of monetary printing that's going on. But fundamentally, we are already in a situation where my money in a bank account basically gets me 0% per year, and the returns on the stock market, we believe the returns on the stock market are going to go south pretty quickly, pretty soon, and that there's going to be this continued amount of economic malaise that occurs in the main markets. Like there's been a lot of talk about crypto being counter-cyclical, and like it's yet to prove that out properly, but a lot of these decentralized finance applications that are allowing you to get yields of 5, 10, 15, 20% on just stable coins, right? So if I've just got some USDC, or if I've just got some DAI, I can earn 15% a year just having that on a lending protocol like Aave, or putting that into something like Compound.
Instead of like the negative interest rates that Dutch banks are currently, offering between brackets.
Exactly. So I think that in the immediate term, where this is going to come out of is the continued building of anger about what the traditional financial system is providing to the everyday person, and an easier and easier pathway for people just to be able to go, well, if I just take my money here and I change it into a stable token. So no speculation on the value of Bitcoin or anything like that. I just change it into dollars, USDC, and then I put it into this protocol. I earn money. Now, obviously, there's a lot of depth and complexity underneath that. Like, why is there money? Where's the yield coming from? Like, why is my money safe? Why is it not going to disappear tomorrow? Like, it still feels like magic. Like that's the thing that a lot of the everyday person is going to have to get through and get over, and get to the point where they start to trust that that is actually really 15% a year. No, there's no catches here. You just need to make sure that you join this new financial ecosystem. And if you get in there now, the rewards are actually pretty high, because there is so much activity that's happening. There's so much economic activity and innovation that's happening. There's actually providing legitimate yield, not like Ponzi yield.
It's of course very important that we say that we are not offering any financial advice at this event. So always at home also check where you're putting your money in. I mean, there have been a lot of scam projects, unfortunately, also in the DeFi field. It was interesting what you mentioned, the upcoming year will see, the effects, of course, of the enduring corona crisis, also in the financial atmosphere. We've seen, of course, the rise of stock prices. Some people argue that like the money printing of governments actually increased prices of crypto assets. So there's also a positive note on that for the owners of cryptocurrency coins. I'm curious to learn from your side, what do you see in the upcoming year happening in the DeFi space? What are you the most interested in? What are you most enthusiastic about? What will happen in DeFi in 2021?
So I still think that DeFi is quite a niche area. So like what I'm excited about will feel quite niche. Like it's niche because it sort of sits at the crossroads of technology and finance, and both are already relatively niche areas. Like the thing that I'm seeing as a macro trend within DeFi is a market-driven, liquidity-driven way of pricing risk. And it's completely different to what is being done in the financial system today. So if I go to Goldman Sachs and say, hey, I want you to price me an option or a forward, or I go to JP Morgan and I say, hey, I want to borrow, the way that they do that is not a market-driven approach. It's essentially they go and run some spreadsheets and they go and like have their own internal models. But what DeFi is doing is it's changing the way that risk pricing and what is offered to people is done via market-driven pricing and liquidity-driven pricing. And that's already hit for things like the constant function market maker. It's already hit for things like continuous lending protocols like Compound and Aave. But I can see that down the road, it's going to also be affecting things like options and derivatives. And like that part of the market is huge, like hidden from most people, but huge. But it's important because it means that you get better hedging projects and products, and you get better ways of de-risking. And that, I think, is going to be key to then fundamentally packaging up things that consumers can actually end up being safe with. Like if you can de-risk something on a high volatility with a better risk pricing model for options, you end up getting to the point where you can get nice consumer products that are sort of hide all of this complexity underneath. And that's what I'm excited about. Like there's still a load of building to go. Like we're still not all the way there, but I see good consumer products that have come out of the DeFi ecosystem in like the next year, 2 years as a result of this better pricing mechanism.
And I really can see the enthusiasm coming from your face. It's like here in Amsterdam, we can like see the energy flowing into our study. Piers Radiaert, thank you so much for your contribution for now, because you will stay with us for the upcoming session, the panel discussion. So if you can, of course, you're staying with us. Thank you for now. Before I'm going to steal all the questions for the upcoming parts of this session, I'm going to hand over to my co-hosts of the panel on DeFi. The panel will be hosted by Balder Bomans. For our international listeners, Balder Bomans from Maven 11, and he will host the panel on DeFi. Balder, welcome.
Thank you, Jan. Thank you. Yeah, great. We're going to be talking any further on decentralized finance, also called open finance, after this very, very inspiring talk by Piers from Radix. The term DeFi was first coined in the course of 2018 by blockchain developers and entrepreneurs building new applications and new protocols for services towards new consumers. Coming 30 minutes, we'll be discussing everything DeFi with 3 amazing panelists, one based in Amsterdam, one based in London, and one based in New York currently. Let me intro them first. First one is Floris van Lieshout. What we would call a crypto OG, has been exploring and researching crypto and Bitcoin since 2011. But he got pulled too hard by the corporate life. Currently works for Deloitte Risk Advisory, Digital Risk Solutions. He's mainly engaged with the financial services industry, advising banks and other service providers around DeFi, tokenization, custody, CBDC, and consortium formations. Then second, on my bottom left, if I'm saying that correctly, is a serial entrepreneur called Dan Roberts. He is currently the CEO of Nimes. NIMS is building the environment to facilitate the underwriting of global digital asset risk to scale vital protection for the vibrant financial ecosystem. He believes in the power of mature, regulated businesses to bridge the gap between traditional finance and the future of our monetary system. And then last but not least, Ryan Burkham launched Fabric Labs before, leading an engineering team to build DeFi infra for protocols like 0x and Tezos. Currently the CEO and founder of Teller Labs, Teller Finance, a risk assessment loan in DeFi. Teller aims to bridge the gap between traditional finance and decentralized finance. Guys, straight into it. We have seen the talk by Radix, by Piers. He's obviously the great presentation about all the possibilities that DeFi is bringing to the market, being non-custodial, it being open, transparent, composable, and decentralized. For our listeners today, how would you describe DeFi in its simplest form? Let's start with Floris yourself, please.
Thanks, Baller, for that great introduction, and thanks for having me here today. In my own words, DeFi, I think Piers actually explained it very well, as it's democratized financial services that are leveling the playing field. It's, I'd say, code-based financial services on a public infrastructure, something like that.
Okay, and Ryan, why do you think DeFi is important? Why should we care? And on a more personal note, why are you building a DeFi yourself currently?
Yeah, hey Boulder, thank you for the fantastic introduction as well. So just from a high level, I think DeFi is a collection of new digital banks that run autonomously without humans. They simply run by code. And as Piers explained, there's a lot of new products that can be built on top that currently needed humans to run them. DeFi is amazing because it immediately globalizes access to these type of financial goods. Anyone around the world with a $20 Android can surf the web with an Ethereum wallet and all of a sudden have access to lending products, trading products, derivatives, synthetic assets, everything that they would have potentially limited to no access to in the traditional centralized financial world, they now have access to with just going to a URL. So it really is an amazing opportunity to lower the barrier of entry for the world at large to enter the financial playing field. And while Piers did mention the large gas costs that it sometimes can have on Ethereum, the reality is interacting with DeFi applications is a lot cheaper than the traditional financial world for those who don't have that much capital at hand. So it really is in the mainstay democratizing access to capital. And I think from a personal note, the thing that's amazing about DeFi is this concept of composability. The idea that you can take from one bank, one digital or decentralized bank, and integrate it into your bank. This has really opened the door for collaboration and really the desire for partnerships within many people in DeFi, which I think drew me initially into the space. And for us, really what we see as the big thing with DeFi is bridging this gap between where people are currently getting value from the centralized world and offering products that really have immediate value capture for users who are not in DeFi today. We see this ability to truly transform the world of what is risk assessment in the traditional financial sense and offer products that use risk assessment in the DeFi world.
Thank you, Ryan. Dan, on your personal motivation to be building a DeFi today, I would also love to hear your voice here.
Sure. Yeah. Thank you for having me on. Personally, the energy that you get in the community is something that we will start seeing people joining and beginning their careers in this space purely because of that fact. I mean, sort of someone who would have gone to work at a large bank 20 years ago, who's joining the workplace, is now joining Maker or Teller or Radix instead, and so that sort of becomes a generational force to bring in these kinds of minds into the space. And then, specifically speaking about the insurance sector, insurance has been trying to digitize for the past 20 years, maybe a little longer. And short, tech as an individual term has really only bridged off from fintech in the past 3 or 4 years. You've started seeing all these incredible applications across claims management and capital allocation and so forth. And it really seems like DeFi is way out at the front, building these sort of futuristic products and services, which comes with its inherent risks, but that poses a opportunity for, again, specifically to insurance, this sort of binding, immutable contract of insurance that doesn't require the lengthy, legal, fragmented process to provide trust to these kinds of interactions. So, going beyond insurance, which is our area, and I guess going back to the question of sort of what is DeFi, which is pretty much being covered very well by everyone else at this point, is really you take the rules and the trust that a sort of central institution provides to a financial interaction, and you just put that on transparent code. Those rules are available to be viewed by anyone, and that means that what it doesn't mean is that every central institution is this inherent evil company out to steal everyone's money. But what it probably means is that actually the rules of these financial products and interactions are relatively straightforward. It's not to say that there's not a lot of work that needs to be done. There's a number of complex areas in this, but once you can define those rules very efficiently, then there is no need for that central institution to provide that trust, and you're left with a transparent, open environment for users to interact with each other directly and with these financial products directly. Personally, it's just a wonderful space to be working in. The kind of energy that we've got on this panel is sort of a regular occurrence.
Thank you, Dan. And indeed, we hear and see that more and more, that people are extremely enthusiastic about building in the space and then building in DeFi specifically. We've touched upon indeed the basics of DeFi. Floor is to yourself. You chatting with many banks and financial institutions. You know their issues. You know what the issues they're seeing. And we're trying to solve these issues with DeFi. What are the key issues, in your opinion, that DeFi is trying to solve? And secondly, would you see DeFi more coming towards banks, or would you see financial institutions more coming towards DeFi in the near future?
Yeah, that's a fascinating question. First of all, having been in DeFi for a little while now, or I think 2015 was when I got into touch with the first DeFi protocols. It's really fascinating to see that it is growing from just white papers and just theoretical startups to actual usable products that bring end users value. And I think that's one of the more fascinating things. And first, it was a very small community of people who were very much into crypto, who were fascinated or almost obsessed with this technology. And I think halfway through this year is at least when we started seeing more interest from financial institutions. And that we saw banks taking notice and asking us to come and have a talk about DeFi, and where we started thinking about, okay, what type of value would DeFi bring to our institutional clients? So the value or the problem that DeFi is solving, if you take away everything and just look at it from an end user perspective, I think it's been said a couple of times now, it's democratizing access to financial services. Right? It's really making it easier for basically just anybody with a smartphone or an internet connection to use rather sophisticated financial instruments. And I think it's also been mentioned that the value as an end user, if you have any crypto assets, you can quite easily use them to have an upside, right? And I think from an institutional perspective, that the interest is there. Well, if you look at banks, I think it will take a while before they really touch it. Right? They're just exploring it now, taking a look at it, trying to understand what it is, where the value is, and how they might potentially be able to leverage it. But I mean, regulatory-wise, it's still pretty unclear for them what the way is that they can offer these products and services to their clients. But perhaps in the end, there would be a way to leverage these services in a way that Coinbase is already doing. Right? Coinbase is offering their users 2% interest on just holding a stable coin on their platform. That's about 2% more, or even more than you get at a regular bank account, specifically now that there's a negative interest, right? So, yeah, I hope that somewhat answers your question, Balder.
Yeah, and then I would like to add on that. Today we're seeing in DeFi mainly crypto assets being used as collateral. What's your expectation for, let's say, more real-life assets like invoice financing or other financing tools to be switched over to more DeFi native protocols?
Yeah, super interesting question. I think a great example here is a project that Coca-Cola North America is doing with Baseline, Unibright, and Provide. Baseline is a way to use the Ethereum mainnet to synchronize various ERPs. Not going to dive into that too much, but one of the things within the context of that pilot that they are researching is invoice factoring, right? Which is reselling your invoice before the other party that has to pay the invoice has actually paid it. And within this project, they are actually tokenizing these invoices and trying to take a look at how to leverage that within DeFi. Right? So imagine that I'm sending you an invoice. You have to pay it within 30 days, but there's this other party that thinks, you know what? I'll just pay Floris 99% of the invoice because I think ultimately Balder will pay that invoice. And now Floris already has 99%, so he's liquid again. And I make an easy 1% within 30 days. Enabling this type of technology through DeFi, I think, is fascinating because it just opens up the market for a lot of other players to take advantage of this type of opportunity. Yeah.
Great, thank you. Ryan, also to yourself, if we see how blockchain has developed over the years, it's been a very strong, let's say, grassroots movement. Now we're getting into a place where we're seeing this grassroots movement building all these DeFi native protocols and these partnerships and building together this very strong movement. And now we're seeing real world life applications. How do you, CEO of Telefinance, build that ecosystem around you, getting people to build on Telefinance and making sure you're going to be important in making standing your flag into the DeFi ecosystem?
Definitely. I think that's a question every DeFi protocol is asking themselves and asking their community as well. So I think the key point to recognize about DeFi and finance is we are creating new economies. We're creating two-sided marketplaces where you need both sides to actually bootstrap a new network. And it's similar to the early 2000s when the social media platforms came out, something like Facebook, like MySpace. Every user was also a creator and a viewer. So in DeFi, a lot of users share the act of being both a lender and a borrower. And that's not only from the lending standpoint, that's both from supplying capital to using capital. That can be something from Compound, where you're actually lending and other people are borrowing, or Uniswap, where you're supplying liquidity into a trading environment and other people are trading that liquidity. So in order to create a DeFi network that really grows, we like to look at something that Facebook kind of initially came out with, something called flywheel effect, where with Facebook, every user that joined the system actually multiplied the network effect of Facebook by n squared, n being the number of users. So you can see as more users join the network, it becomes exponentially more valuable to every user within the network. And that's how we like to see crypto networks and DeFi networks specifically. I think we've seen this meteoric rise in DeFi because of the network effect and this flywheel of making money on your money. in ways that are not nearly anywhere accessible in the traditional world, especially as Boris mentioned, with the bank account earning you 0 to negative interest. So with Teller specifically, a lot of our focus is bootstrapping that network and bootstrapping that community, where we need to solve first, of course, the supply side, bootstrapping total value locked and AUM, because that allows access to loans backed by data, backed by credit, and access to that capital, because then we are able to solve the other side of the market, which is the borrowing side and the ability for offering value to consumers that want to access capital for specific use cases. And then for every protocol, we kind of see this ratchet effect, where as more AUM is entering the system, borrowers have more access to different types of activities in DeFi that they want to borrow for, more borrowing activity happens, and then more people want to deposit AUM. And this is without even going into some of the incentives that have been rolled out over the past 6 months, where actual projects have given off what we call governance tokens or rights to ownership of a protocol that have actually significantly incentivized the first part of that model, which is bootstrapping and fostering the initial AUM, or total value locked, the supply side of the network. So with Teller, and I think with all other DeFi projects, it's this really interesting mechanism design, which just is a combination of creating a new economy plus building a token network and into it and delivering value to the end consumer that you want to bootstrap. And making sure that you're not simply bootstrapping something that is here in the moment, something here for DeFi, but it is a full-fledged product and protocol that can act as a financial primitive for the next 10 to 20 years. And this is the same way that we saw internet protocols being developed, something like HTTPS or Apache, something that will withstand the test of time and be a primitive that anyone else can build on top of.
Great examples there around the flywheel effect. Really enjoyed those. I would like to also ask yourself, you're building a solution which wants to cross over traditional finance to decentralized finance or open finance for that matter. How would you say, what's the view of the sort of more US ecosystem on what you're building today from the traditional finance side?
So from the traditional finance side, they're definitely experimenting with it. As Floris mentioned, banks are looking into it. But I think there's two different types of value propositions that DeFi can offer different types of financial institutions. There's the lending side, which is, of course, you stake your capital, you're able to earn exponentially more than what you would be earning today through just the normal lending markets. This has seen some adoption, and institutions and banks are taking notice. The issue kind of keeps coming along, which is what is the compliance risk? What is the actual custodian risk? How do I know that my money is safe, even if it is earning 5% instead of 0.5%? No one has really addressed the other side of the market, which is the access to capital. And what we see is interesting, while asking an institution to offer AUM and offer capital, there are inherent risks to that. The opposite side really does lower the barrier of entry, where you're asking an institution, say, hey, here's another line of capital. And the way we perceive adoption of DeFi into traditional finance and fintech institutions is through that effect, by saying DeFi is another money rail. So instead of you having to either A, acquire a bank like a peer-to-peer company like Lending Club had to do, or B, source capital from a bank like other fintech institutions have to do today, here's another access to capital. Here's another money rail, which is DeFi. And all of a sudden, these financial institutions, by plugging into this, can create products that they create today, risk assessed, plugging in data from the real world, building on top of Teller, that they can actually source liquidity from the DeFi market through Teller and integrating directly into their own platforms. So someone like Robinhood, for example, could offer a new type of leverage trading product to their consumers. And what's interesting is the capital for that could be sourced directly from DeFi users that understand how and where their money is actually going. So it really just broadens the access to capital for these fintech institutions and significantly lowers the barrier of entry for them to offer new financial products. Of course, this comes with the world of compliance, and every financial institution is going to have to check these boxes of compliance before they're really able to fully process and operate and offer these types of DeFi-based risk-assessed products to their consumers.
Perfect. We happily see them coming towards the DeFi industry. Although DeFi has seen a lot of positive developments over the especially the last 2 years, we've also seen some what we call in the industry rug pulls, where people are issuing new contracts and the money is gone. But at the same time, we've also noticed that the industry has quite a good sense of being self-regulatory. So Dan, to yourself, you are working on the risk side of things. What would you say are the main risks for DeFi today, and how is the industry handling those?
Yeah, so there's a whole process in thinking about it. One of the good places to start is who's liable for the different risks. It's sort of like the self-driving car, autonomous car question of if a car owns itself, who's liable if there's a fatality from a crash? Is it the manufacturer? Is it someone who was in the car at the time, the guy behind the non-existent wheel? Is it a company who perhaps owns them? And it's the same in the DeFi space. It's going to be a very interesting question over time to see how DeFi is actually regulated kind of outside in. But you can certainly regulate sort of fringe services. And by them, I mean, names being one of them, a sort of bridge between some of these centralized finance and traditional finance worlds, us being in insurance, and the sort of internal hub of the DeFi activity. So there's a couple of trends going on. One of the interesting ones being that you're now getting, particularly when we look at insurance, sort of bespoke insurance companies and brokers that are coming out of the woodworks to service this space specifically. And they're regulated as normal underwriters and brokers, and they have the actuary divisions and so forth, skills to assess different types of risk. But do so in a sort of context of serving this space instead of going to a large traditional incumbent underwriter to provide that kind of underwriting expertise, which in most cases would be less efficient than an individual underwriter doing it, sort of coming from the native space. So the different risks, once they start looking at these different pockets of this industry, and particularly when looking at who's liable, where what sort of niche risks can be covered in small amounts and increased over time. It varies. A common one in the DeFi space is a smart contract cover, so a loss to code not executing as expected. Tech errors and emissions is sort of akin to that. But really, if we look at sort of digital assets more broadly, it's really just a question of how do you sort of bridge capital to risk, and you leave it down to the brokers to figure out what specific types of cover needs to provide that sort of cover. And there's all sorts of ways that you can mitigate that further. And I think if you look at DeFi, it's very much a space that is pushing ahead with innovation, regardless of not so much regardless of the risks, but there's a spectrum of risk appetite that is happening outside of regulated space, which is sort of the right way to approach it, really. But I think this was alluded to with peers earlier. You have this sort of problem of iterating on a project that then, even if you don't sort of see that being the case, lots and lots of user activity occurs, and you haven't gone through that testing. And that's great to go out early, but at the same time, there should still be these sort of audit processes. You've got a number of sort of very experienced audit firms now that can track these on an ongoing basis, and whenever new code is pushed out onto these protocols, that they should be properly tested, and actually the sort of insurance cover in whatever form that happens to come behind that will start to require these kinds of processes in place. It doesn't mean that this sort of rapid innovation can't happen on the front end. But really, I think the best thing to come out of this DeFi space are the robust tools that are going to be used over the long term, instead of some of the sort of 5,000% APR sort of projects that we see in the first instance. That they're sort of great gateways into understanding what this space can do, but it's the long sustainable products and services that are going to be used over the long term, and they're the ones that are going to be better understood, well audited, and therefore insurable.
Thanks, great. And following on that then, I think it's great to see that we're seeing these insurers now coming to the market, starting to learn about these different DeFi native protocols and the risks included. If you would see today, what is the total outstanding amount of cover we're seeing today among these different DeFi protocols in terms of notional value, and what would you expect for the coming 2 to 3 years? It's a big question maybe, but trying to get your brain here.
I mean, it's relatively low for digital assets as a whole. So when you look at DeFi in particular, and DeFi is probably, well, it is at the front end of this kind of new innovation, least understood. The cover is even lower. It's probably changed over the past 6 months or so, but the whole space, $500 billion plus market for sort of cryptocurrencies market cap is 95-96% uninsured, and that's probably going to be a little higher in the DeFi space as this risk is starting to be understood. So I think there's companies like Nexus Mutual that are doing a fantastic job of providing that initial underwriting capacity to individual users, and doing so in the language that those kinds of users are completely used to. There will be a challenge to provide increased limits over time through that sort of product, which is what we would really love to support as well. And then over the next 2-3 years, I think the question is really how well can these protocols present themselves as secure sources that have transparent sort of loss histories, and sort of start speaking the language that these underwriters like to speak. And as I mentioned, you have these bespoke underwriters that are focused purely on these pockets of risk within the digital asset space that are starting to, the sort of language barrier is merging very, very quickly. What's clear, at least on my side, is that specifically around mitigating risks, is that sort of insurance scalability problem will be a collaboration between regulated underwriters, but again, they can be bespoke for the space, not the big grey head underwriters of incumbents. And capital markets that are already native to the space. So it's not as if you can't source the appropriate scalable capital. Insurance can be an asset class and is a normal asset class in the traditional markets. There's no reason why it can't be an asset class in this space for institutional investors and even retail investors, the sort of long tail. So you sort of have the capital source. It's just that means in the middle of sourcing it into good versus bad risk, and so you still need that kind of regulated pricing mechanism in the middle to make sure that risk isn't ending up in the hands of someone who doesn't understand what the risk is. And not that the DeFi space has shown us that people aren't happy taking on such risk. So yeah, it'll be very interesting to see, and obviously there's a bigger space in the cryptocurrency world outside of DeFi, and very excited to see DeFi become a larger and larger part of what we're trying to do. Bitcoin was a decentralized money. DeFi has created these decentralized financial products and services. It seems a very, very natural evolution that it will continue to go in that direction over time.
I could not agree more with yourself then, and especially, if you want to onboard that next wave of users, either being institutional consumer, then obviously insurance is one of the key items that we need to solve to safeguard deposits or any form of asset or money. Guys, we're getting to the end of the panel today. Obviously, I don't want to leave without sort of getting your visions for the future. So what would you say it's needed to onboard the next, let's say, big cohort of users? I think we're currently at around 20,000 users if we're talking about DeFi as a whole, maybe even a little less. So how we're going to onboard the next wave of users in the DeFi ecosystem? And secondly, what's your expectation for how the total value locked might look down the lines, let's say end of 2021? The floor is yours.
Yeah, good question. So what does it need to grow, right? I think time and regulatory clarity. MiCA is in the works. I think that will allow a lot of institutions clarity on what is asked for them. But maybe most importantly, we need more users to grow. And I think in the previous section, Piers was asked a question. What do you think it will take for people to play around with this? I think just do it. Just go there and experiment with it and experience how much fun it is to just with a little bit of capital go and play around with a couple of these DeFi apps. It's a whole different world from than it was in 2017 when you still needed quite extensive computer skills, I would say. And today there are so much more easier interfaces. If you just download a plugin for your browser and buy, let's say, 50 or $100 to play around, just go and play around with it and see that it's simple and there's some actual value there for you. And as to what it might look like at the end of 2021, it's always very risky to say stuff like this, but if you look at the growth rate from mid of this year to today, I think we went 15x or something. I think it was mid-June when the total value locked of DeFi hit 1 billion, and today we're pushing up until 15 billion. So in another year, who knows? We might actually hit that 100 billion, or we might pop the bubble and be back somewhere around 10. I have no idea. But yeah, it could go either way, really. But overall, I think the sentiment is quite bullish for next year.
Thanks yourself, Ryan.
Yeah, coming off what Floris mentioned, I think a lot of this market and getting into it is having capital at stake and just playing around with these applications. It is so much fun when you are using something, and even if you don't fully understand the mechanics, when you have skin in the game, immediately you are incentivized and mentally willing to go read through documentation, understand how it works, because it's real money on the line, even if it's just play money. So that's something that I would totally encourage anyone who's watching this today. I think what's really interesting about the adoption in DeFi is that the products that gain success at any point in time in DeFi are actually those that were built for the users, the majority of users who are currently in DeFi at that time. At first, we had applications like MakerDAO that really were built for those more technically or crypto native. Then we had platforms like Compound and atMaven where it's simpler. You simply deposit assets into a front-end interface and all of a sudden you're earning interest. And then I think as the adoption and understanding and comfortability of depositing your assets in a smart contract took place, we started seeing these insane yields, these 5,000% yields, which started bringing crypto native people from other areas of crypto into DeFi and seeing it as the next frontier of DeFi. I think we're entering this next wave now of DeFi as platforms are heating up. I think we're seeing more tangible products being released, and even with this concept of fair launch products where potentially there's no VC backing, there's no investors, we're seeing real projects that aren't based on speculative yield, but are based on actual resources that could be used in the long term in DeFi. And I think what's interesting is each point of the adoption curve is critical and necessary, because kind of taking a book out of the way Steve Jobs looked at startups, every layer of technology is just another layer of sand. We're all standing on the shoulders of giants, and DeFi exposes that in an insanely fast and iterative and expanding way, where a lot of projects today are built on the yield or lending earning projects of a year ago, or maybe even just 6 months ago. So every layer of DeFi builds on top of itself to offer new value to the next cohort of individuals that will bring it. Of course, from our perspective, we really see the next massive cohort of users coming in from traditional kind of applications that users use today, like something like Robinhood, something like SoFi, applications where these fintech platforms or companies already have hundreds of millions of users, and they could start piloting with these type of DeFi applications. and offering just immediate value to their consumers. Something that's really exciting is what Dan brought up. These bespoke insurance companies are kind of coming out of the woodwork because all of a sudden there is interest and in this new financial ecosystem. I think we're going to see the same in 2021 as the crypto market continues to expand, as the DeFi market continues to expand. We see these financial technology firms coming out of the woodwork to integrate different components of DeFi. And in terms of a projection, let's see if we can get to 1 trillion by the end of 2021.
That's a big one, Ryan.
1 trillion in DeFi.
Okay.
Well, crazy prediction, but
Thanks, Ryan. Dan, your last, I do got to say, you got around 40 seconds. I'm having people screaming in my ear. So if you could keep it a little short, thank you, man. Ryan took your time, sorry.
No worries. Yeah, obviously from my side, one of the things that's needed is insurance. There's lots of things that are needed, but I don't just mean any old insurance, and specifically not traditional insurance in that sense, but insurance created and designed specifically for to serve this space and to get Ryan to his 1 trillion total locked value. And then really the final bit of what it'll look like. My only hope is that, and this seems pretty likely, is that we'll come out of let's say this initial sort of significant interest in DeFi with just more robust projects, better processes, better security, better understanding. Regardless of where total lock value ends up, it's going to be really interesting to see the emerging sort of winning standards and protocols that people are using over the long term. So very excited for this next year. It's a good time to be involved.
That's a great way to close off this panel. Thank you so much, Dan. Thank you, Ryan. Thank you, Floris. All the three of you for being here today. Ryan, you especially for waking up so early in the US. Great. Thanks for being on this panel. I hope you learned a lot about DeFi. Do follow these three guys, and I'm going to hand it over to Jan from here. Thank you.
All right, Balder, and of course the distinguished members of the panel. Thank you so much. Thank you so much for this fascinating panel. I think we are at the start of this incredible transformation of the foundations of our financial foundations of our society. So it was, for me at least, very interesting to hear your point of view from the DeFi perspective, how this can actually play a role in the upcoming future, upcoming months. What we've just heard, developments are going very fast. We are having a very short break at the moment. We will have a short break of around 7 minutes. So 5 to 3, we will start the next session. So 5 to 3. This promises to be a very, very interesting session with speakers from Africa, Dubai and New York, with presenting all kinds of incredible impact stories. So please have a 7-minute break and we will see you back in at 5 to 3. All right, see you.